Good morning. These are the things that matter most before Wall Street opens. The jobs report can reset the rate path. Software earnings are trying to prove AI demand outside the megacaps. Oil risk is back through the Strait of Hormuz, and the underappreciated story is a supply chain squeeze inside optical and memory hardware. The central question is simple. Can Wall Street broaden today, or does every rally still need proof from jobs, software demand, and energy costs at the same time? Start with jobs and rates. CNBC reported that July non-farm payrolls are expected to show a gain of just 83,000 with unemployment unchanged at 4.2%. Yahoo Finance also reported that stock futures rebounded as the jobs report loomed, with traders watching whether the data changes the Federal Reserve outlook. For private investors, this is the first filter because jobs can help or hurt in two directions. A softer labor number can support rate cut hopes, but it can also raise growth worries. A stronger number can support earnings demand, but it can keep yields sticky. The useful question is not simply good jobs or bad jobs. It is whether banks, small caps, bonds, and growth stocks all tell the same story after the number. The cleaner side is quality banks, profitable cyclicals, and software names if the market reads the data as soft landing. Pressure sits with long-duration growth, home builders, and leveraged companies if yields refuse to fall. The private investor takeaway is this. The jobs report is not a headline. It is a cross-market confirmation test. Second, AI software is trying to broaden the market. Yahoo Finance reported that Dow futures rose as Cloudflare led big software winners, and it also carried a Barron's item saying Akamai, Atlassian, Cloudflare, and JFrog helped explain the day as software stocks led the broader market higher after solid earnings eased fears about AI disruption. Separately, Yahoo Finance reported that Cloudflare shares jumped after a forecast raise on resilient AI-driven demand. That matters because the AI trade has been too dependent on megacap proof. If Cloudflare, Atlassian, Akamai, and JFrog can show durable demand, then AI is not only a Nvidia or hyperscaler story. But this is still selective. The market is asking which software companies are helped by AI traffic, security, and developer demand, and which ones are only borrowing the AI label. Potential beneficiaries are Cloudflare-style network demand, security software, developer tools, and infrastructure firms with real usage growth. Pressure sits with expensive software that cannot show AI conversion, and with hardware or memory names where demand exists but expectations are already stretched. For private investors, the filter is usage turning into guidance, not just AI vocabulary. Third, oil is again a margin and inflation test. CNBC reported that oil rose as Iran's draft plan would ban the U.S. and Israel from the Strait of Hormuz, and another CNBC item said traffic near Hormuz was close to standstill as diplomacy deteriorated. That is not a small commodity footnote. It touches inflation expectations, airlines, transport, consumers, and energy cash flow. The cleaner side is integrated energy, selected refiners, and energy service groups if crude risk stays elevated. Pressure sits with airlines, transports, and consumer margin stories if fuel or input costs rise faster than demand. In plain English, oil can help one part of the index and squeeze another at the same time. The fourth filter is the underappreciated supply chain story. CNBC reported that SK Hynix plans to invest $38 billion in new memory chip plants as demand soars. MarketWatch also flagged that optical stocks have a China problem that many investors are missing, because Beijing controls a choke point Washington's crackdown cannot fully address. This is important because AI infrastructure is not only chips and cloud platforms. It also depends on memory, optical components, power, and cross-border supply chains. The cleaner side is companies with secured capacity, pricing power, and diversified supply. Pressure sits with crowded memory, optical, or AI infrastructure names if investors discover that one choke point can slow the whole story. For private investors, the practical takeaway is this. AI demand can be real and still run into physical bottlenecks. There is also a policy read-through. CNBC reported that solar stocks rose after new China tariffs on polysilicon products. That shows how tariffs can create winners and protected domestic capacity while squeezing import-dependent buyers. The same logic applies across supply chains. Who benefits from protection, who pays higher input costs, and who gets caught between policy and margins? Here is the stock-led watch list for the U.S. session. First, JP Morgan, regional banks, IWM, and TLT. Do jobs and yields confirm a soft landing setup? Or do they split the tape again? Second, Cloudflare, Atlassian, Akamai, and JFrog. Is AI software demand real enough to broaden leadership beyond the megacaps? Third, Nvidia, Microsoft, and Amazon. Do the AI leaders confirm infrastructure demand without reviving capex and power cost doubts? Fourth, Exxon, Chevron, United Airlines, and Delta. Does Hormuz risk become energy leadership or a margin tax on travel and consumers? Fifth, SK Hynix-linked memory, Micron, Western Digital, and optical network suppliers. Does the supply chain confirm AI capacity or reveal the next choke point? Market bias, selective, data-driven, and proof-first. The setup can support risk assets if the jobs report keeps rate hopes alive, if software earnings prove AI demand beyond megacaps, and if oil risk does not tighten margins across the tape. The mistake to avoid today is treating a futures rebound as a full market answer. The better filter is confirmation across three places: labor and yields, software demand, and energy or supply chain costs. That is the U.S. pre-market brief for Friday, August 7th. We are watching whether Wall Street can turn a rebound into broader evidence. Research context only. This briefing is not investment advice. It is not a recommendation to buy, sell, or hold any security, and it does not include price targets, stop losses, position sizing, or personal financial advice.